We've never seen anything like it. The markets are going to boom, the stock is going to boom, the country is going to boom.
Unless you have been living under a literal rock, you have probably heard that the President of the United States has imposed a set of punishing tariffs that have led to a stock market freefall. We are currently seeing the worst market downturn since the COVID pandemic hit in 2020, with more than $4 trillion being wiped off in a single week. Worse still, many are drawing parallels to the events which sparked the Great Depression and the 2008 financial crisis, and which ultimately led to an unimaginable level of economic misery. Such a dramatic downturn in the stock market is clearly a big deal. But why? What is the stock market, and why does it matter so much when we think of the global economy? This is what we'll be covering in this video, but before we get into it, this is Minecraft, and I like to do takes and make explainers about all the fascinating topics that affect our lives, be it tech, economics, science, history, or philosophy. If you find this video useful, make sure to like and subscribe. Okay, let's get into it. To understand the stock market, it would be useful to imagine someone wanting to open up a biscuit business. Andrea has this amazing idea about a new flavor that is likely to do really well, but she has very little money. What she can do is offer her company to the public through a process called an initial public offering, or IPO. At this point, Andrea's business is on the official stock market, where anyone that believes in her idea can buy a stock or a small part of her business. The more demand there is to invest in a business, the more the stock price will rise, leading to profits for those initial investors. The extra money will allow Andrea to expand the business and make it even more profitable. Andrea can also choose to pay her investors part of her profits. This is called dividends, and is likely to keep investors happy and entice others to invest as well. So when people see that a business is doing well, they want to buy stock from it, even if it costs more than what the original investors bought it for, because they believe that the stock price will rise even more and they will be able to make an even greater profit later down the line. The money the company collects when it sells its stock is called capital, and the concept of issuing shares of stock in exchange for capital is the key concept of the economic system under which most of us live and which is known as capitalism. This is, in simple terms, the stock market. It is the buying and selling of stocks on the basis of what the investors believe these stocks are likely to be worth in the future. Every country has its own stock market, but the most prominent in the global economy is thought to be the New York Stock Exchange, which is home to more traditional and established companies like IBM or Accenture. The second most important stock exchange is the Nasdaq, and it is also based in the US. It was set up in 1972, and so it is a lot younger than the New York Stock Exchange, which was created as far back as 1792. The Nasdaq does not have any offices. Rather, all its operations take place electronically, and it tends to be the home of newer companies like Apple and Netflix that are focused on tech and innovation. Overall, investing feels great when there is a lot of confidence in the market and everything seems to be going smoothly for the global economy. But if news impacting a business negatively come out and investors start believing that a company will do worse in the future, they are likely to start selling their stock to avoid losing money when the stock price goes down. This is what happened when the US announced a 10% blanket tariff across the world, with higher tariffs for the EU, China, and the Asia-Pacific region. Because so many businesses in the Western world depend on importing materials and products from these countries, investors started feeling uncertain about the future of the companies they had invested in and quickly sought to sell their stocks as to preserve their current profits. This is also where human psychology comes in. It sounds insane to say, but there is no actual money in the stock market. There is only potential money. Let's say you have bought £1,000 in shares of Apple stock, and its current market value is $2,000. You want to get that profit, and so you order the sale of the stock. But by the time the order is executed, a huge disruption in the market, like the issuing of global tariffs or the onslaught of war, means that there is a stock market correction, and now the stock is only worth £500. You will probably be very frustrated by this, since you are losing rather than gaining money. But the point is that that money was not there to begin with. The market price of a stock, once you have bought it, depends entirely on the perception of future potential profit to be made by the underlying company. Essentially, the price of the stock is based on what people believe it is worth to have a share of that company's profits. So yeah, the very principle on which our financial system is based on is kind of made up. And we have recently seen the biggest economic uncertainty in the modern era, higher than the COVID pandemic or even 9/11. Yikes. It is important to note, however, that stock market crashes are not always aligned to economic recessions. Economist Paul Samuelson famously quipped in 1966 that Wall Street indexes predicted 9 out of the last 5 recessions. Putting the comic hyperbole aside, what Samuelson meant was that stock market climb downs are more frequent than the recessions that accompany them. Not every stock market crash has led to a recession, but virtually every single recession has been accompanied by a stock market climb down. And this is why a stock market crash is so important to watch out for. Because even if it does not correlate to a recession directly, it is one of the most telling indicators that one might be imminent. This is because during a stock market crash, people and businesses lose a lot of money, fast. Suddenly, everyone feels poorer. And when people feel poorer, they spend less. Businesses get nervous too and start cutting back on investments or hiring. Another contributing factor is that companies often raise money by selling stock. When prices crash, it's much harder for them to get the cash they need to grow because people are afraid to invest, so they pull back on expansion and new projects. All this creates a negative feedback loop. Falling stock prices make everyone more pessimistic. People spend less overall because they fear an oncoming recession. Businesses invest less, and that can spiral into layoffs and even more economic slowdown. So, what's the takeaway from this? Well, it is certainly concerning that JP Morgan's chief economist recently raised his prediction of a global recession in 2025 to 60% from 40%. Ultimately, however, it is too soon to say whether a recession is imminent. The stock market is an early indicator of potential economic trouble, but it is based on investor perceptions of the economic future rather than on hard data. So yes, in a capitalist economy, we should all care about the stock market, but do so with an awareness that it does not always paint the full picture.